Welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. Now, this is the show where we tell you what is the best direction for your mutual fund investments and strategy. And we're talking today about large cap funds. Now, large cap funds are back in focus, perhaps will soon be back in vogue. The context is an advisory issued by SEBI last week directing AMCs to moderate flows into mid and small cap funds and rebalance portfolios. Does that mean that we will now see more inflows coming into large caps? If so, is it time for you to also relook at your portfolio? How should you do that? What are the best large cap stocks to pick? For context, on an average, large cap funds have given a return of about 39% in the last 1 year, not shabby at all. But small cap and mid cap funds have given over 50% returns. And this is why they have continued to attract a lot of investments, especially from retail investors. To speak more on this and how you should perhaps relook at some of those large cap funds, we're joined today by Mrin Agarwal, founder of FinSafe India, and Rushabh, founder of Rupee with Rushabh Investment Services. Welcome to both of you. Thank you so much for speaking with us today. Mrin, let me begin with you and we'll start with your overview on the subject that we've picked. Large cap funds have always been an investor favorite, especially for, I would say, first time investors or those who are beginning their investment journey. They always find it a safe bet. How much should it account for in your portfolio in terms of large cap funds? And of course, the pertinent question today, is it time to relook and rebalance tilting towards large cap funds?
So good afternoon, Tamanna. And well, I think, large cap needs to be part of everybody's portfolio, right? Given the fact that it is an indicator of how economy is also doing, right? So I think large caps need to be in everybody's portfolio. Now, should you move out of small caps and get into large caps, especially, when we're talking about the mutual fund space, right? So, of course, I think, the decision to choose a particular market cap is truly based on the risk-taking ability. While valuations in small and mid caps have run up much above the averages, right? So I think they're like 25 to 30% above the long-term averages. I still feel that if people are in the investment or are in the fund for the long term, then they can continue to hold their investment. But of course, you need to keep in mind that there's been a run up, which means that you may see some sort of a correction. And of course, what is really important is to just remain invested. So my answer would be yes, large cap needs to be part of everybody's portfolio. But should you actually move out of a small cap fund and then move into a large cap fund at this space? Well, it depends on the risk-taking ability and the time horizon. We have seen a lot of people who've entered these funds in the last 1 year based upon the great performance. And certainly they need to evaluate at this point whether they can hold it for the next 10 years. If they can't, then they need to actually get out of equity.
If you can't, then you get out of equity. You have to be able to hold. The question is about returns. And Rushabh, I come to you on this point. The reason that small cap and mid cap funds have been so attractive is because of the kind of returns they are giving. And it's a cycle of sorts, right? If investors pour money into these funds, then fund managers have to go out and buy these stocks, which bring up their prices, and then there is more money coming into the funds. Now, will that virtuous cycle of sorts, in your view, shift to large cap funds? And is it a time to relook at large cap funds?
Tamanna, thank you so much for having me on the show. I absolutely agree with Mrin that, what she had to say, particularly that, large cap valuations are quite reasonable at this point of time compared to mid and small caps. But I would also say one thing and one backing that, what Mrin said, that, stick with your asset allocation. I always tell my clients that, stick with your goals, understand your goals, what is your risk appetite, what is your time horizon, and then form your asset allocation. See, even today, if someone wants to invest in mid and small caps, if they have a long-term time horizon, then definitely it's not a bad idea to invest in the mid and small cap space. But the only thing is that if you invest at the wrong time, we always say that, timing time in the markets is more important than timing. But actually, I don't agree with that, because see, if you invest at the wrong time, and however long if time horizon you have, you're still going to be disappointed with the returns what you're getting in the mid and small cap. See, when investors invest in the mid and small cap space, they are definitely going to expect a higher kind of returns, not only compared to large cap, but just overall. When markets rally, and when investors stick in the product for say 5, 7, 10 years, they're definitely going to expect superior double digit returns. So in my view, I think if someone invests today in the mid and small cap space, then definitely expect a low to moderate kind of returns, even from a long term point of view. But if you stick with your asset allocation, I think that's the best strategy going forward. Investors should continue with their SIP, but only thing investors should be cautious is about the lump sum investment, especially in the mid and small cap space.
Um, Lump sum investment in mid and small, be cautious. But now, what about the focus back on large caps? How do you approach this, Rishabh? Give us, actionable sort of intelligence that our viewers and investors can look at. And if they want to rebalance their portfolios, first of all, how much of your portfolio should be large cap funds?
See, Tamanna, this is actually a great time if someone wants to rebalance in the mid and small cap space. Say, for example, if someone has an allocation decided of say 50% into mid and small caps, and if their allocation has shifted from 50 to say probably 70, 75 or 80, and if they are uncomfortable with that additional risk what they are taking over and above of 50% what they have decided, then of course trimming down that additional risk and coming back to their original allocation of around 50% would be great. So this is a great time if someone wants to reduce their risk in the mid and small cap space. This is a great time to rebalance, number one. Number two, as you correctly pointed out, this is also a great time to focus on the large cap space. There are three reasons for that. One is that the valuations are reasonable. Number two, that large cap over a 3 to 5 year period has underperformed the mid and small cap segment. And number three, over the past 3 years from 2021 to 2023, value as a segment did tremendously well compared to growth, right? So these are the three reasons I feel, that one should look at the large cap segment. Now, how should investors invest in the large cap space? There are two ways to do that. One is they can look at the traditional large cap funds. Although I am not recommending active large cap funds at this point of time, so they can choose the index large cap funds, which is the Nifty 50 and Sensex plan. And second, because we have seen a lot of flexi cap funds which have been tilted towards large caps around at an average around 50 to 60% of the flexi cap around 50 to 60% of flexi cap funds have exposure in the large cap, heavy large cap segment. So either they can go for the traditional large cap index funds or flexi cap funds which are tilted towards large caps.
Okay. I just want to take that question with Mrin as well, in terms of which would be the best options for large caps right now, Mrin?
Well, I also concur with Rishabh that I prefer index funds myself because they turn out to be lower cost. And if you look at the long-term performances, again, you would find that the index funds would be a better, would give you a better return compared to the actively managed large cap funds. I also agree that a good way to play the large cap space is through flexi caps as well, because then you are not having to look at altering the allocation between large, mid, and small caps. So I would say that. But yes, I mean, if you were to ask me right now, funds that have done really well in the large cap space and which have actually beaten the benchmark on a rolling return basis would be Canara, Robeco, and Axis.
Okay, so Canara and Robeco, and Axis would be your top picks, Mrin?
Yeah, sure. On the actively managed side, of course, on the index side, a good Nifty 50 index fund like ICICI would work well.
Okay. Rishabh, your specific funds that you would prefer, you said, you prefer index funds as well, but the picks that you have in terms of large cap funds?
So there are four picks, Tamanna. One is UTI Nifty 50 fund. Second is HDFC Sensex fund. And on the FlexiCap side, they can look at DSP FlexiCap fund and UTI FlexiCap fund. So these are the four funds one can look at, creating a portfolio in the large cap segment.
Okay, so now this is the section of the show where we answer your queries and some very interesting ones that we have today. Rishabh Desai and Mrin Agarwal are our experts who are going to be answering your questions. And the first one is from Srirang, aged 65 years. Their goal is medical expenses and really funding medical expenses. He says, I had a SIP in SBI Equity Hybrid Mutual Fund, but stopped it after it collected a corpus of 1 lakh rupees. Now I am looking for a mutual fund that will provide support for future medical expenses. This is a very, very important query because after a certain age, if you don't have a pre-existing medical policy that covers you, you might find it difficult to get insurance. There will be a lot of, illnesses, hospital visits, checkups, some things that just do not get covered, but those expenses keep adding up as you grow older. And this is something that we often overlook. Using mutual funds as a vehicle to make sure that any unfortunate medical issue doesn't end up wiping out your savings. So thank you, Mr. Srirang, for sending in that query. I'm going to take Mrin's view first on this. And Mrin, if Mr. Srirang is starting now and is looking for a mutual fund that will provide support for future medical expenses, how does he go about doing it?
Well, given his age and given the goal, which is for future medical expenses, which could happen at any point in time, I would say that he should probably look at investing in an ultra short duration debt fund or into a short duration debt fund if he can hold some amount for 3 years, right? So he could always plan the corpus in such a way that a part of it is in ultra short duration that can be immediately pulled out as and when required, and the balance amount could be in a short duration debt fund. And in both the cases, yes, I do recommend ICICI and HDFC in both of these cases. But yeah, I would just stay safe and certainly not have like an investment that has an equity allocation because it can be volatile and at the time of need it may not be it could be down or something of that sort, right? So better to stay safe on this.
Okay, so even say versus a good old FD for this profile, you're saying a debt fund is better, Mrin?
It's slightly better. I mean, of course, you can look at fixed deposit also. It's just that fixed deposits come with some prepayment penalty and all of that. So I just find that the mutual funds are more liquid in nature. Of course, you could look at keeping a 25% in fixed deposit because if it's a real emergency, you need an instrument where you can just withdraw the money right away. And a flexi deposit would work well over there.
Okay, so a flexi deposit debt fund is what Mrin suggests. Rishabh, how would you advise Mr. Srirang, who's written into us?
Mrin, Tamanna, I absolutely agree with what Mrin had to say. Stick with ultra short duration or low duration or even liquid funds, matter of fact, because, at this point of time, liquidity is very important. Having a conservative approach at this age is very important. That is why we advisors, we always say, start early, have your medical insurance done very early so that, there are you need to pay low premiums for that because when you age, see, although I'm not an insurance expert, but as you age and then when you take an insurance policy, you would need to pay a higher premium, and in many of the cases or certain of the cases, the insurance people don't even give you an insurance. So starting early is very important, and especially at this point of time, having a conservative approach in debt mutual funds and fixed deposits should do the job.
All right. Next query is from Johnson JK. Is aged 54 years. The goal is a retirement fund. Now, he says, my son is currently in the US and has an NRE account. He wants to start 5 SIPs and invest 10,000 each for future retirement corpus. Okay, so the retirement is not for Mr. Johnson, age 54, for his son. So what funds would you recommend? Now, we're not very sure how old Mr. Johnson's son is, but if he's 54, one would assume he's 30 at the very least. What would you advise, Mrin?
Well, I would say that since he is young and he has time to go for retirement, he can certainly take some amount of risk, and I would veer towards going towards mid and small cap funds. And I would suggest like Mirae or Kotak on the mid cap side, and on the small cap side, of course, Nippon. Of course, they'll have to check which are the funds that are taking investments right now. But yes, I think these would be the fund choices that I would actually recommend. Of course, if they want to play it slightly safer, then they can go in for flexi cap funds.
Okay, so flexi cap funds if they want to play it safer. Now, does NRE account holder have to do anything additional, Rushabh? And of course, the funds that you would suggest, but since this detail has been mentioned that Mr. Johnson J.K.'s son is an NRE account holder, what does that mean in terms of tax liabilities, etc.?
See, when you're an NRI, right, there are certain mutual funds which don't allow, investments. So I think, first of all, I'm assuming, his age to be probably towards the end of 20s or a little bit early 30s. I would suggest, 60%, anywhere between 50 to 60% in the flexi cap strategy, and the rest can be divided into the mid and small cap space. There should be no issue in terms of SIP, or in terms of, as long as, he has the KYC done and NRI status to be updated. I don't think there will be any issue, for his investments. But just check it with, the AMCs, that which funds are allowed and which funds are not allowed.
Which are your top picks in this flexi cap segment, Rushabh?
There are two funds. What I can think of is, one is Parag Parikh Flexi Cap Fund and DSP Flexi Cap Fund at this point of time.
And Mrind, do you want to give any specific advice to Mr. Johnson's son?
Well, of course, the main thing would be to again remain invested, right? And I think, there is one additional requirement, which is there is a US declaration form that they need to sign as well. And some of the AMCs also need you to be physically present in India at this when you're doing when you're signing up for the investment. So I think, as Rishabh said, that it's good to check with the AMCs and check out the AMC websites for the specific requirements.
Okay, so obviously convenience also becomes a factor when you make that choice if you're an NRI, because if you are not available to come down and do the paperwork, etc., then you might want a fund that makes it easier for you. All right, the next question is from Dilna, who's 36 years old, and the goal is a retirement fund. She says, I've been holding an Axis Blue Chip fund with a 5,000 rupee SIP, UTI Nifty Next 50 Index Fund, 10,000 rupees, and I'm planning to consolidate them into a single large and mid-cap fund to simplify my portfolio. But I'm divided between the Zerodha Nifty 250 large and mid-cap index fund, which is passively managed, and the HDFC large and mid-cap fund, which is actively managed. Could you recommend one of these options or suggest another large and mid-cap fund? You know what is interesting in this question is, first of all, it's a retirement goal, and I'm glad to see more and more people planning now for retirement. Secondly, it also brings up the question of whether you should go for a passive or an active fund, especially when she wants to move to a large and mid-cap fund. Bryn, what would you advise Dilna?
Well, it would have been good to know what would be the reason to actually get out of two funds and move into just one, but that's fine. That's their choice. See, the difference is really going to be in terms of expense ratio, about 0.6%, and the active versus the passive strategy. Now, in these days, I find that a lot of investors feel that the passive strategy is always going to work out best. And that's not true. It's not like, every fund in the passive space or every fund in the actively managed space is going to underperform the passive fund, or that's going to underperform the benchmark, right? So I think, what is really important is that don't get into a passive fund just because you're reading or someone's telling you that, oh, your good passive funds are better. I've heard a lot of people saying passive funds are going to perform better than active funds. There's no way for anybody to know that. They're just less expensive. So, as long as she's clear about that fact, I think it's okay for her to choose a passive fund if she feels more comfortable with that versus going in with an actively managed fund. So that's what I would suggest. Of course, I always say that it's always good to have diversification in your strategy. So, but here I can't even suggest that because she wants to consolidate two funds into one fund. So I can't tell her to have a passive fund and an active fund. So choose based on what you're more comfortable with and the strategy that you feel is going to do better. But at this point, there's no data to say, which is going to perform better. It's just that
She has
one is
given two options. She has given two specific options and asked which one is better.
Yeah, so I would still want to go with the actively managed fund rather
Okay.
than just going with the passively managed fund.
Okay, in this case, that's the HDFC Large and Mid Cap Fund because those are the two options she's given. It's interesting because when Zerodha started its mutual fund venture, Nitin Kamath actually put out, and he put this out on Twitter, on why they've gone for entirely passive funds. And they say broader market exposure seems to be the only space where investors with moderate risk appetite can build a healthy portfolio and also sleep peacefully at the same time. So that seems to be the theory for why passive funds. Rishabh, your advice to our viewer?
Tamanna, I think to just keep it very simple is, have one active fund and one passive fund because it's large and mid cap. So around, 40-50% will be in large caps and 40-50% will be in the mid cap space. So have one active fund and one passive fund because we have to accept the fact that today a lot of active funds are, underperforming even from a 7-year or a 10-year perspective, right? And 7-year and 10-year periods are very long period of time, and AMCs are charging a good percentage, out of your kitty, on an annual basis in terms of expense ratio. So to keep it very simply, have one passive fund and one active fund. I think the anxiety what she has will be definitely reduced quite a lot.
One for which she wants a large and mid cap fund. So which one should be active and which one should be passive?
Have one large and mid cap active fund and one large and mid cap passive
Okay.
fund. You really don't need a lot of funds in your portfolio because large and mid caps, the combination is a very good combination. Even if the small cap segment is missing, the mid cap space would give quite well returns over a longer period of time. So she can stick with Zerodha Nifty 250 index, large and mid cap index, and HDFC large and mid cap fund. I think she'll be very well sorted.
Okay, so no need for an either or, do an and. Take both, Dilna. That's at least the advice coming from Rishabh. All right, that's all the time we have. You know where to reach us if you want to send us a query. Those numbers are on your screen. We hope to hear from you and, of course, see you back here on the Mutual Fund Show Monday to Friday on NDTV Profit at 1:30 in the afternoon. For now, Rishabh, Marin, thank you so much for joining us. And for viewers, thank you so much for tuning in. But don't go anywhere. We're right back after the break.